Today, redefining a pivot. Hello again, it's Martin North from Digital Finance Analytics, one of the list posts covering finance and property news with a distinctively Australian flavour. Well, the Bank of Canada unexpectedly slowed its pace of rate increases on Wednesday amid concern that Canada's economy is already flirting with a recession. Governor Tiff Macklem boosted the benchmark overnight lending rate by 50 basis points. That means hiking by 350 basis points since March, instead of the three-quarter move expected by markets and most economists.
Today, we raised the policy interest rate by 50 basis points to 3.75%. This is the sixth consecutive increase since March, and quantitative tightening continues and is complementing increases in the policy interest rate. We also expect our policy rate will need to increase further. How much further will depend on how monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding to this tightening cycle. Our decision today reflects several considerations. First, inflation in Canada remains high and broad-based. Inflation has come down in recent months, but we have yet to see a generalized decline in price pressures. Second, and related, the economy is still in excess demand. It's overheated. Households and businesses want to buy more goods and services than the economy can produce, and this is driving prices up. Third, higher interest rates are beginning to weigh on growth. This is increasingly evident in interest rate-sensitive parts of the economy, like housing and spending on big-ticket items. But the effects of higher interest rates will take time to spread through the economy. Fourth, there are no easy outs to restoring price stability. We need the economy to slow to rebalance demand and supply and relieve price pressures. We expect growth will stall in the next few quarters. In other words, growth close to zero. But once we get through this slowdown, growth will pick up, our economy will grow solidly, and the benefits of low and predictable inflation will be restored. Finally, we're trying to balance the risks of under and over tightening. If we don't do enough, Canadians will continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. If we do too much, we could slow the economy more than needed. And we know that has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. This tightening phase will draw to a close. We are getting closer, but we're not there yet. We are carefully assessing the effects of higher interest rates on economic activity and inflation. And we are being clear with Canadians and focusing on the job we've been assigned, to restore price stability for the benefit of all. Let me expand on these considerations and highlight the key points in the Governing Council's deliberations. Turning to Canadian developments, the Governing Council devoted considerable attention to assessing inflation expectations, and the balance between demand and supply in the economy. Since June, inflation in Canada has come down from 8.1% to 6.9%. Though welcome, most of that decline reflects a drop in gasoline prices. Inflation in Canada is broad-based, reflecting large increases in both goods and services prices. About 2/3 of CPI components have risen by more than 5% over the last year. And rising prices for essentials like groceries and rent are hitting lower-income Canadians particularly hard. Short-term movements in total CPI inflation are often dominated by swings in volatile international prices like oil prices. That's why we're watching measures of core inflation closely for signs that price pressures in Canada are easing. Our preferred core measures have stopped rising in the last couple of months, but they have yet to show clear evidence that underlying inflation is coming down. Looking ahead, there are some early encouraging signs. Businesses have said they expect the rate of price increases for the goods and services they sell will come down. And more timely, 3-month rates of core inflation have declined, although they are still averaging about 4%. We're going to need to see these 3-month rates come down further and those declines be sustained. We are also looking for evidence that near-term inflation expectations are easing and that longer-term expectations are centered on our 2% inflation target. Near-term expectations remain high, and our surveys suggest that uncertainty about where inflation is headed remains unusually elevated. Looking at indicators of labor markets and economic activity, it's clear that even though the economy has started to slow, it remains in excess demand. Job vacancies have declined from their peak, but remain high, and businesses continue to report widespread labor shortages. With the economy now fully reopened, households want to enjoy many close contact services they have missed, but businesses can't keep up, and we have seen prices for services rise rapidly. Higher policy rates are beginning to slow demand. Higher mortgage rates have contributed to a sharp slowing in housing activity from unsustainable levels, and consumer and business spending on goods is moderating. This has led to declines in house prices and is exerting downward pressure on goods prices. Moving forward, we expect the effects of higher interest rates will continue to work through the economy, moderating household spending and business investment. Slowing global growth, particularly in the United States, will also weigh on Canadian exports. We project GDP growth will stall through the end of this year and the first half of 2023 before picking up in the second half. Annual average GDP growth is therefore projected to decline from about 3.25% this year to just under 1% next year and about 2% in 2024. With growth below potential for several quarters, excess demand in the economy dissipates, and the economy moves into excess supply in 2023. Putting the global and Canadian outlooks together, we expect inflation will hover around 7% in the final quarter of this year, fall to around 3% by the end of next year, and return to the 2% target by the end of 2024.
Those expectations were based in part on Macklem's October the 14th remarks, when he said that the bigger policy risk was under-tightening. 5 days later, Statistics Canada reported headline inflation of 6.9% for September, which appeared to seal the case for a larger hike. This tightening phase will draw to a close. We're getting closer, but we aren't there yet, Macklem told reporters during the press conference after the decision. So, what drove that decision? Well, it seems a deteriorating global backdrop, slowing domestic growth, early signs of a softening labour market, and faster than expected declines in headline inflation. All those outweighed concerns about a weakening Canadian dollar ahead of a likely 75 basis point hike by the Fed next week, sticky core inflation, and only modest improvements in inflation expectations. For all the concerns about the currency, this morning's for all the concerns about the currency, the decision didn't have a sustained impact on the Canadian dollar, though government bonds were down sharply. Macklem told reporters after the decision that the hiking cycle is approaching its end, even though there are more increases to come. This tightening phase will draw to a close. We're getting closer, but we aren't there yet, the governor said in an opening statement. So was political pressure applied? Well, last weekend, Jagmeet Singh, the leader of the New Democratic Party, said there is no merit to the Bank of Canada's approach to steep rate hikes and argued it unfairly punished lower-income Canadians. In fact, he released a letter addressed to Prime Minister Justin Trudeau that said the central bank was already laying the groundwork for a recession. Singh's party was an alliance with Trudeau's Liberal government to ensure it can pass key legislation. This is a masterclass in how not to communicate, Andrew Kelvin, Chief Canada Strategist at Toronto Dominion Bank, said. Surprising dovishly after political figures started suggesting the bank slow the pace of rate hikes, will raise questions about commitment and credibility. Benjamin Revies, an economist at Bank of Montreal, agreed one potentially prickly point for policymakers is that a number of politicians have been weighing in on the policy decisions of recent weeks, stating that large rate hikes aren't appropriate anymore. Expect plenty of chatter about political influence, whether real or perceived. And asked on Wednesday whether his credibility had been damaged, Macklem deflected the question.
Governor, I'm wondering how you are assessing your credibility these days, and if that plays into your decision on rates at all. Do you have to raise rates any? Do you have to be more aggressive, I guess, now that in order to keep your credibility, now that you have politicians on all sides kind of questioning you?
Look, we need to do what we have to do. We have a very clear mandate. We're committed to achieving our mandate. We are trying to balance the risks on both sides. We don't want to under tighten. Inflation's not going to fade away by itself. And if we ignore the problem, if we're half-hearted in our response, inflation, Canadians will have to continue enduring high inflation. They'll have to continue to cope with the anxiety of high inflation. Nobody wants that. We're also very conscious, though, that if we over-tighten, the economy will slow more than is needed. That'll make life more difficult for Canadians than it's needed, and will undershoot our inflation target. So we don't want to do that either. These are difficult decisions. I will say that the independence of the central bank becomes more important when the decisions are difficult.
To some economists, the bank's decision is all about the evidence of a slowing economy, not politics. The central bank cut its growth projection for 2023 in half to just 0.9%. I think the economic forecast justifies what they did, said Dominique Lapointe, Director of Macro Strategy at Man Life Investment Management. Certainly, Canada's central bank had got out ahead of peers in boosting its key rate by a full percentage point back in July, a magnitude others stopped short of. So now it joins Australia, of course, in easing somewhat on the brakes, with officials in both countries sharing worries about the impact of higher borrowing costs on highly indebted households. By hiking less than consensus forecast, the Bank of Canada's policy decision is reinforcing the notion of a more generalised central bank pivot. Mohamed El Arin, Chief Economic Advisor at Allianz SE, said on Twitter. And he notes that markets are now defining pivot to mean a slower pace of rate hikes rather than outright end or turning to lower rates.
This as maybe a pivot by the Bank of Canada that, as you said, very big or even big rate increases are now coming to an end, and we're going to have a return to more traditional quarter point increases given the economic forecast.
Well, we did 100, we did 75, today we did 50. We've signaled very clearly that we expect rates will need to rise further. That could mean another bigger than normal increase. It could mean that we can move to more normal size 25 basis point increases. We've been very clear on the things we're watching as we take those decisions, and it's going to depend on how the effects of higher interest rates are feeding through to slowing demand. It's going to depend on what we see in inflation and inflation expectations. And to some extent, clearly, inflation is going to be affected by international developments and how those global supply chains disruptions resolve.
Canada's two-year bond yield slumped below 4% for the first time in more than 2 weeks, and the US 10-year yield dipped briefly below 4% after the Bank of Canada's decision, although it recovered after. Thank you, Canada, Ed Moyer, senior market analyst at Onya, wrote after the announcement, highlighting how the move spurred riskier assets, including US equities. Traders are still fully expecting the US Federal Reserve to lift rates by 75 basis points next week for a fourth straight meeting, but Canada's shift illustrates that central banks around the world are getting closer to the end of the tightening cycle, with policymakers hoping the cumulative impact of their efforts will soon start showing up in the inflation data. Of course, the Reserve Bank downshifted its pace of policy here in Australia, tightening by a quarter point, ending a string of half-point moves. And of course, we'll know more next week about what they're going to do. Like Canada, it did so in the knowledge that the Australian household sector is among the world's most indebted. Still, the fresh data yesterday showed that headline inflation still accelerated by the most in 32 years in the third quarter. Both Canada and Australia have housing market finance models that make their economies more vulnerable to rapid rate hikes. Evercore ISI analysts Peter Williams and Krishna Goon wrote in the note. Still, there is some global read-through from the Bank of Canada move, they said. With growth outlooks slowing everywhere, monetary policy is starting to be a bit more forward-looking again, even if the primary concern remains inflation persistence, they wrote. At the Fed, Chairman Jerome Powell wants clear evidence inflation is slowing, and that's not yet happening. At next week's gathering, officials are expected to debate, leaving the option open to keep going at a 75 basis point pace or downshift potentially in December. While downshifting may open central bankers to criticism from those seeing the need for sustained outside moves, it reflects the belief that it takes time for the higher borrowing costs to spread through the economy. Higher interest rates are beginning to weigh on growth, Macklem said at the press conference. This is increasingly evident in interest rate sensitive parts of the economy, like housing and spending on big ticket items. The Bank of Canada also revised down its growth forecasts, predicting the economic expansion will stall and possibly even contract in coming months. It expects inflation will fall sharply to below 3% by the end of next year, within its target range for the first time since early 2021, as higher borrowing costs curb spending. Justifying what is still an outsized rate hike, the Bank of Canada continued to emphasise high and broadly based inflation and domestic price pressures stemming from excess demand and tight labour market conditions, but at the same time the policy statement noted a challenging global growth backdrop and evidence that policy tightening is slowing domestic activity beyond its early impact on housing. GDP growth is now projected to essentially stall in the coming quarters.
In the monetary policy report, you note it's as likely to see several quarters of negative growth as it is to see positive growth. Are you saying a recession is likely at this point, or a possibility at this point? And how is that? I guess how have your assessments of a possible soft landing changed with the new update?
Mark, our mandate is clear. Our primary responsibility is to restore price stability. We have been raising interest rates rapidly to achieve that goal. And the other thing I would stress is by front-loading our policy response, we're trying to avoid the need for even bigger interest rates down the road and an even more pronounced slowing. As you mentioned, our latest outlook, we have growth stalling for the next several quarters. To be more precise, growth is close to zero in the fourth quarter of this year and the first two quarters, the first half of next year. What that does, what that means is that, yes, a couple, 2-3 quarters of slightly negative growth is just as likely as 2 or 3 quarters of slightly positive growth. That's not a severe contraction, but it is a significant slowing of the economy. And we certainly are seeing clearer signs that the economy is slowing. With growth essentially zero for the next several quarters, that will give the supply the opportunity to catch up with demand, and that will relieve price pressures in our economy. Unfortunately, there's no easy out to restoring price stability. We actually need a period of slower growth to let supply catch up and relieve those price pressures. As we get through that period of slower growth, growth's going to pick up, economy's going to grow solidly, and we're going to have low inflation. So Canadians are not going to have to cope with the anxiety of high inflation.
So while the Bank of Canada isn't using the R word, it acknowledged a couple of quarters with growth slightly below zero is just as likely as a couple of quarters with a small positive growth. That might be as close as the central bank will come to calling a recession until we've actually got one. While the Bank of Canada cut its 2023 growth forecast in half to 0.9%, that's still well above the expectations of some economists at 0.2%. Any failure by the Fed to also downshift in coming months leaves Canada open to the risk of further currency depreciation in the dynamic that could worsen its own inflation. A strengthening US dollar has been one way the Fed has effectively exported some of its inflation problems to other countries. The Canadian dollar is down about 5% against the US counterpart over the past 3 months. Another risk is that inflation doesn't come back down to more normal levels, undermining the Bank of Canada's credibility with households and businesses at a time when inflation expectations are already elevated. The central bank is trying to thread the needle of taming inflation while not putting too much pressure on the economy. Benjamin Ritz, Canadian rate and macro strategist at BMO Capital Markets, said in the note, hopefully that doesn't come back to haunt them in 2023 if inflation remains stickier than expected. And with regard to the markets, well, the Dow closed flat on Wednesday, weighed down by a rout in Microsoft and Alphabet following underwhelming quarterly results. The Dow Jones Industrial Average rose 0.01%, the Nasdaq was down 2%, and the S&P 500 fell 0.74%. Alphabet was more than 9% down after its third quarter revenue and profit fell short of Wall Street estimates amid the impact from slower advertising revenue that is expected to continue. Management's quarter 4 outlook for overall advertising business to continue to be impacted by difficult year-over-year comps and continued headwinds within certain ads and vertical and formats. Goldman Sachs said in the note. Meta Platforms closed more than 5% lower and fell further into the red in after-hours trading after third quarter earnings fell short of Wall Street estimates. Microsoft, meanwhile, fell more than 7% as weaker growth in its cloud business Azure and software guidance overshadowed quarterly results that topped Wall Street estimates. The biggest surprise was that core Azure Office 365 implied growth was reduced more than expected as an enterprise spending slowdown is well underway, and MSFT is guiding accordingly, Wedbush said in its cut to the price target of Microsoft to $290 from $320. Energy was up more than 1%, and that bucked the broader trend, led by gains in Hess Corporation, ConocoPhillips, and Halliburton Company. Hess Corporation rose more than 4% after reporting better than expected quarterly results, driven by stronger production. Halliburton was boosted by an upgrade from Wells Fargo to overweight from equal weight, citing room for further gains in oil prices. Visa, meanwhile, closed nearly 5% higher after reporting quarterly results that topped estimates on both the top and bottom lines, driven by ongoing consumer spending and a recovery in cross-border activity. So you can see here that the markets are a bit of all over the place, as we said they would be, with volatile moves up and then down again. The tech sector is clearly under pressure, and those driven specifically by ad revenue will be the most severely affected. And they are some of the biggest companies in the index, so expect more falls there. And with regard to the broader question about what central banks will do, well, clearly the market's now starting to redefine a pivot from dropping rates to slowing the pace of rising rates, which suggests, of course, that we will continue to see higher rates ahead, and that will put more pressure on households and businesses. And it does take a long time for those higher rates to percolate through, maybe 18 months into the real economy, which means the risk of over-tightening is still there, and therefore the downside risks to markets and to economies is still very much intact. Next step, of course, will be what the Reserve Bank does on Melbourne Cup Day next Tuesday. And of course, we'll be back to talk about that at the time. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.